This is video lecture 2 for Accounting 200, Chapter 12. So we're going to look at accounting for dividends. When a board of directors declares a cash dividend, it authorizes the distribution of cash to stakeholders. When a board of directors declares a stock dividend, it authorizes the distribution of its stock. In both cases, declaring a dividend reduces the retained earnings of the corporation. So whenever you look at it, remember whenever you were a small business, it was called a cash draw. Well, that's very similar to that. Cash dividends, a cash distribution of earnings by a corporation to its stakeholders is a cash dividend. Although dividends may be paid in other assets, cash dividends are most common. 3 conditions for a cash dividend are as follows: sufficient retained earnings, sufficient cash, formal action by the board of directors. There must be a sufficient or large enough balance in retained earnings to declare a cash dividend. That is, the balance of retained earnings must be large enough so that the dividend does not create a debit balance in the retained earnings account. However, because the balances of cash and retained earnings are often unrelated, a large retained earnings balance does not mean that there is cash available to pay dividends. Even if there are sufficient retained earnings in cash, a corporation's board of directors is not required to pay dividends. Nevertheless, many corporations pay quarterly cash dividends to make their stock more attractive to investors. Special or extra dividends may also be paid when a corporation experiences higher than normal profits. Cash dividends, 3 dates include in a dividend announcement are as follows: date of declaration, date of record, date of payment. The date of declaration is the date the board of directors formally authorizes the payment of the dividend. On this date, the corporation incurs the liability to pay the amount of the dividend. The date of record is the date the corporation uses to determine which stockholders receive the dividend. During the period of time when the date of declaration and the date of record, the stock price is quoted as selling with dividends. This means that any investors purchasing the stock before the date of record will receive the dividend. The date of payment is the date the corporation will pay the dividend to the stockholders who owned the stock on the date of record. During the period of time between the record date and payment date, the stock price is quoted as selling ex dividends. This means that since the date of record has passed, any new investors will not receive the dividend. To illustrate, here's an example. $100, 5,000 share outstanding, dividend per share $2.50, so total dividends will be $12,500. Common stock $10 par, 100,000 shares, 30 cents, $30,000. So total dividend paid will be $42,500. On October 1, so here's another example. Here's how we record it. Cash dividends $42,500, cash dividends payable $42,500. Notice we did this as a payable, okay? So here now we're paying it $42,500. We're pulling that balance cash dividends out of the payable. Now we're actually crediting cash, so it's actually coming out of the cash account. Stock dividends. A stock dividend is a distribution of shares of stock to stockholders. Stock dividends are normally declared only on common stock and issued to common stockholders. A stock dividend affects only stockholders' equity. Specifically, the amount of the stock dividend is transferred from retained earnings to paid in capital. The amount transferred is normally the fair value or market price on that particular date of the shares issued in the stock dividend. So to illustrate, so here's an example: common stock $20 par, 2 million shares, so that's 40 million. Paid in capital in excess of par common stock will be 9 million, so retained earnings will be 26,600,000. Okay, so here's an example here at the bottom. We'll take a look at that. So it says 5%, okay, and so let's look at that. So to record it, stock dividends of 3.1 million, and that's 5% of the $100,000, $31 share. So stock dividend distribution of 2 million, and then paid in capital in excess of par common stock is 1.1 million. Okay, so at the end of the accounting period, the stock dividend account is closed to retain earnings, and the stock dividends distributable and paid in capital in excess of par common stock accounts are reported in the paid in capital section of the balance sheet. Thus, the effect of the preceding stock dividend is to transfer $3.1 million of retained earnings to paid in capital. So here's what this might look like. Stock dividends distributable, $2 million, common stock, $2 million, and that's on those 100,000 shares. A stock dividend does not change the assets, liabilities, or total stockholders' equity of a corporation. Likewise, a stock dividend does not change an individual stockholder's proportionate interest equity in the corporation. So here's an example: 10,000 shares before, then there's 1,000 number of shares owned, proportionate ownership 10%, and then so over here on the right it'll be 10 times 6%, so that'll get 10,600. Same with the 100,000. So this is your principal and that's your interest. So add those two and it'll be 10%. Okay, 10,600 divided by 10,600 is 10%. So here's a checkup. Go ahead and take a look at this one, read it in the book, and then here's another piece of information. So here's how we would take into account this cash dividend of 9,000. Cash dividend is payable of 9,000. So all we did was create it. So then there's no entry to record which stockholder received the dividend. So then now on March 10th, cash dividend is payable. We're pulling that out. All we did was pull it out of here because we're going to pay it now. So cash is credited for 9,000. August 30, 3,000 shares. So stock dividend of 180,000. Stock dividend is distributable, 60,000. Paid in cash in excess of par common stock is 120,000. And then there's no entry for the person who's going to receive it or the partners or shareholders. And then on August 31, stock dividend distributable, and that's right here that we're pulling out and paying. So common stock, 60,000. Excuse me. So stock split is a process by which a corporation reduces the par or stated value of its common stock and issues a proportionate number of additional shares. A stock split applies to all common shares, including the unissued and issued shares. A major objective of a stock split is to reduce the market price per share of the stock. This attracts more investors and broadens the types and numbers of stockholders. So here's an example of a stock split. So basically what happens is your stock doubles, okay? So number of shares, 10,000. After the split, it goes to 50,000. So the par value is 1,000. So this will be $20 after we split it. Okay, and then let's see. So here's an example. Here's graphically before stock split, 4 shares at $1 per share. After is a 5-to-1 stock split, so 20 shares at $20 par value per share. So, okay. Stock split, so stock splits do not require journal entry because only the par or stated value and number of shares outstanding have changed. However, the details of stock splits are normally disclosed in the notes to the financial statement. Treasury stock transaction, so is a stock that a corporation has issued and then reacquired. A corporation may reacquire, purchase its own stock for a variety of reasons, including the following: to provide shares for resale to employees, to issue as bonuses to employees, to support the market price of the stock. So the cost method is usually used to record the purchase and resale of treasury stock. Using the cost method, treasury stock is debited for the cost or purchase price of the stock. When the stock is resold, treasury stock is credited for its cost. Any difference between the cost and the selling price is debited or credited to paid in capital from sale of treasury stock. So here's an example. Common stock at $25 par, 20,000 shares are authorized and issued. 500,000 excess price over par will be 150,000, so total is 650. So on February 13, purchased 1,000 shares, $45. Sold 600 shares and at $60. Sold the remaining 400 shares for $40. So let's take a look at that. So treasury stock 45,000, cash 45,000. So we paid it. Cash was received for 36,000. Treasury stock, sorry, cooking bacon this morning. Treasury stock 27,000, and then paid in capital. Treasury stock 9,000, and then lastly, cash of 16,000 received. Paid in capital from sale of treasury stock 2,000, and then of the remaining 400 shares will be 18,000 from treasury stock. So here's another example. So take a look at that. It's also in the book. No dividends, so we'll look at this right here in just a bit. So the checkup corner again. So we're going through all of these items, and then here's what they want us to do: journalize and then the balance. So treasury stock 300,000, cash 300,000, so it's paid out, and then cash of 216. So we sold those 6,000 shares at $36, and then treasury stock 180. So paid in capital from sale of treasury stock is 36,000. So those two still equal 216. Cash 68,000, treasury stock 60,000. Paid in capital from the sale of the treasury stock, and these notes are right down here so you can see how those values we got to those values. So the last component is the 36 plus the 8. So this plus this, it gives us this 44,000 from the sale. Stockholders' equity on the balance sheet. Two methods may be used to report stockholders' equity. So the two methods: each class of stock is reported, followed by its related paid in capital accounts. Retained earnings is then reported, followed by a deduction for treasury stock. The second, the stock accounts are reported, followed by paid in capital, reported as a single item. Additional paid in capital, retained earnings is then reported, followed by a deduction for treasury stock. So here's what it would look like. Here's method 1, and here's method 2. So go take a look at those. They're pretty interesting. To me, this is more detailed than the bottom one. So take a look at that. Okay. So significant change in stockholders' equity during a period may also be presented in a statement of stockholders' equity or in the notes to the financial statement. So the notes to the financial statement are important. I notice a lot of these transactions, a lot of times they're required by the GAAP or GASB to be reported in the notes to the financial statement. So changes in retained earnings may be reported using one of the following: separate retained earnings statement, combined income and retained earnings statement, statement of stockholders' equity. When a separate retained earnings statement is prepared, the beginning balance of retained earnings is reported, the net income is then added, or net loss is subtracted, and any dividends are subtracted to arrive at the ending retained earnings for the period. So here's an example. So take a look at that beginning net income. Net income does go to this. Preferred stock and common stock, so total 7,500. So deduct 7,500 from those two, we arrive at 105,000. So the difference for that between 180 and 75 is 105. So retained earnings increased by let's see, what's the difference? 105. So restrictions: the use of retained earnings for payments of dividends may be restricted by action of a corporation's board of directors. Such restrictions, sometimes called appropriations, remain part of the retained earnings. These restrictions are usually disclosed in the notes to the financial statement. Another note: restrictions of retained earnings are classified as follows. Legal state may require restriction of retained earnings. For example, states may restrict retained earnings by the amount of treasury stock purchased. In this way, legal capital cannot be used for dividends. Contractual: a corporation may enter into contracts that require restrictions of retained earnings. For example, a bank loan may restrict retained earnings so that money for repaying the loan cannot be used for dividends. So very, very specific uses. Discretionary: a corporation's board of directors may restrict retained earnings voluntarily. For example, the board may restrict retained earnings and thus limit dividend distribution so that more money is available for expanding the business. Okay, prior period adjustments. So go ahead and take a look at that. That's where we have to go to a prior period and make adjustments. Statement of stockholders' equity: when a corporation has changed its stock and paid in capital accounts as well as retained earnings, a statement of stockholders' equity is normally prepared. Statement of stockholders' equity is prepared in the columnar format. The column is is a major stockholders equity classification. Changes in each classification are then described in the left-hand column. So here's an example. Take a look at that. And reporting stockholders equity for Alphabet Inc. So here's another example to take a look at the equity account of Alphabet Incorporation on the balance sheet. And then here's the statement of stockholders equity ending December 31. Okay, changes and stuff like that, it'll be noted on there. And notice here's then some notes to the bottom. Earnings per share is net income minus preferred dividends, average number of common shares outstanding. So then here's an example. So net income, prior year, recent year, and then $1.31 to $3.56. Okay, so that's the end of this chapter 12. If you have any questions, please email me. Please get your homework in. I've been flexible with this, so if you need additional time, let me know. Thank you. Have a good day.